I think one of the questions we've always asked is what should we expect on price on a scratch and dent loan? Well, in the scratch and dent or alternative secondary markets, nobody ever posts a rate sheet, and if they did, it would be inaccurate, and we wouldn't be able to base any pricing decisions off of it. So I kind of look at it in three tranches. First tranche is, can this loan be delivered to the GSEs? So that's typically a loan that has not been repurchased from Fannie, Freddie, Ginnie, first of all. And second of all, you own the loan because of an investor overlay. Your underwriter made a minor error and created an investor overlay. Now, these loans, depending on the age, typically always fetch in the 90s or above, and we've had plenty of experiences that they're above par. But you should always count on mid to high 90s on a loan that can go to the GSEs. The second piece is what we call the true scratch and dent market. And there's a really broad variance in price there. In the scratch and dent markets, the investors are really focused on the collateral. What is the collateral worth? Because they're constantly thinking about an exit. How am I going to get out of this loan and make my money by getting out of this loan? So whether that's they do a principal reduction and refinance the borrower, whether they do a rate reduction and refinance the borrower, but in most cases there's an expense associated with it. So it's the value of the collateral compared to the value of the collateral at the time of the close, compared to what their exit strategy plans are and how long it will take them to execute that strategy. And lastly, there's non-performing loans. Now, non-performing loans are very self-explanatory. There's an imminent foreclosure, an imminent deed in lieu. These loans end up fetching 50% or less most of the time. There are occasions that are higher depending on the housing market, but as a seller, I always want to go into that thinking 50 cents because the buyers buying this loan, they're incurring the foreclosure costs, they're incurring the marketing time, they're incurring the realtor expenses, and they're incurring the risk of the property depreciating even more from the time they bought it. So ultimately, it's three tranches. What can be delivered to the GSEs? Well into the 90s is the price. What is a true scratch and dent? And that could be 50 to 85, and it really all depends on collateral and equity in the property. And then lastly, non-performing loans, which fetch the lowest price.